Hi, my name is Jacob Franklin, the developer of StockwarePro, a stock analysis software. Stock analysis falls into two broad categories: technical analysis and fundamental analysis. In the bottom menu, you can see two tabs: technical and fundamental. In technical analysis, the historical stock price of a company is analyzed using mathematical tools called technical indicators to predict the future movement of its stock price for a given time period. Here I have opened the stock price chart of Microsoft for the last several years. Below that are our two proprietary technical indicators, Franklin Oscillator and Franklin Momentum Oscillator. Based on these, we create buy-sell signals like these for different trading strategies as shown here, but that is for another video. Now let us open the fundamental analysis page of this company. In fundamental analysis, the financial statements filed by the company with the regulator quarterly and annually are analyzed using accounting methods to estimate the financial strength or weakness of that company and its earning potential. Financial statements are usually in the form of tables like that in an Excel sheet, but here it is shown as charts and graphs so that it is easier to understand. The top part of this page shows the general information about this company, the country and the exchange in which it is traded, its market capitalization, the outstanding shares, the general area of business of this company, the latest news, financial news that is published for this company, the market day prices, and the 52-week range and high and low prices can be seen from this top section. The charts on the bottom left side shows the financial statements on a yearly and quarterly basis. The financial statement includes the income statement, the cash flow statement, and the balance sheet. Income statement looks at past profitability, and analysts can use it to compare year-on-year or quarter-on-quarter performance of the company. Company management can use it to check if their efforts to control the operating expenses is paying off. Let us take a look at the components of the income statement. Income statement evaluates four main items: revenue, income, expenses, and losses. It starts with the total revenue, and after discounting for expenses and losses, estimates the net income, and finally evaluates the earnings per share. Let us take a closer look at the income statement. It shows that the total revenue was $143 billion for the year 2020. One of the items here is cost of revenue, which is the expense incurred for manufacturing the product that the company is selling. So when you subtract cost of revenue from the total revenue, you get the gross profit. This shows that it is around $96 billion. And when you take any other incomes which the company has over the last year and then subtract any other losses incurred by the company, then you get the net income, which is slightly lower, which is around $44 billion. If you look at these two charts, they are exactly the same. So the net income and the earnings are basically the same. So net income is one of the main items that you will be able to understand from the income statement. Now, operating expenses is the sum of the cost of revenue, selling and general expense, and any R&D related expense. When you subtract operating expense from the total revenue, you get operating income. Operating income is basically the same as EBIT, or earnings before interest and taxes. EBIT is useful in comparing two stocks or companies that fall under different tax regimes. Now, the continuing operations income is the sum of any other income or expense, interest expense, and any applicable taxes. Now, after discounting for any non-recurring events, you can calculate the common shares income from the continuing operations income. So you can see here these two charts are also essentially the same. So common shares income in this case here is the same as the earnings. So from the common shares income you can calculate the earnings per share. For that you divide this value 44.3 divided by 7.56, that is the shares outstanding, and you will get it around $5.8 per share. So that is the earnings per share. If you divide the company's share price by its earnings per share, you will get the price to earnings ratio or PE ratio. This shows how much the market is willing to pay for each dollar of earnings. EPS and PE ratio are some of the many indicators you could use to pick stocks. Now let us take a look at the cash flow statement. While income statement includes all cash and non-cash revenue and expenses, cash flow statement shows the exact amount of a company's cash inflows and outflows over a period of time. It gives information about the cash receipts, cash payments, and the net change in cash resulting from operating, investing, and financing activities of the company during the period. Cash flow from operating activities shows the cash generating abilities of a company's core business activities. Increasing cash flow from operating activities is a good indicator of the profitability potential of this company. Cash flow from investing activities involves cash transactions for the purchase or sale of fixed or long-term assets like plant, property, and equipment. Capital expenditure is included in this. Cash from financing activities includes cash obtained or paid back from capital fundraising efforts such as equity issuance of stocks, debt, loans taken out or paid back. Increasing cash flow from financing means more money is coming into the company than flowing out. When number is negative, like in this case, it means the company is paying off debt or is making dividend payments or stock buybacks. A few other items like change to account receivables, if negative, shows that more customers are paying off their credit accounts. A positive change to inventory would mean the company has spent cash to purchase raw materials. While income statement and cash flow statement shows the performance of the company over a period of time, balance sheet gives a snapshot of the company financials at a particular date like the end of quarter or year end. A balance sheet reports a company's assets, liabilities, and the shareholders' equity. In fact, the total assets of the company is the sum of total liabilities and the total shareholders' equity. Total assets are composed of cash, which is the most liquid form of asset, total current assets, which is assets that can be converted to cash in short notice, and long-term assets like inventory, property, plant, equipment, short-term investments, long-term investments, net receivables, and net tangible assets. Liabilities are money that the company owes to its suppliers, creditors, and others in the form of rent, utilities, and salaries. Total current liabilities are those that are due within a year, while long-term liabilities like short-term debt and long-term debt are due at any point after 1 year. Shareholders' equity is a claim of shareholders on the total assets of the company after the debts have been paid. Retained earnings is part of shareholders' equity that is not paid to shareholders as dividends but is retained by the company. A number of ratios can be derived from the balance sheet to help investors assess the financial strength of the company. Let us use this utility here to check some of the main financial ratios of this company in comparison with its competitors. The debt over equity ratio is an important metric in fundamental analysis. It is a ratio of total liabilities over total shareholders' equity. It shows how much the shareholders' wealth will cover all outstanding debts. So a lower D over E value is better. Current ratio here is current assets divided by current liabilities. It is a liquidity ratio that measures a company's ability to cover its short-term obligations with its current assets. So a larger value is better. Price over earnings ratio, or the PE ratio, is something we looked at earlier when we examined income statement. It is an indication of whether the share price is overvalued or undervalued. Usually, a lower PE value is preferred since it suggests expectations are not too high and the company is more likely to outperform earning forecast. Sometimes actual earnings does surprise the market, which we call as EPS surprises. Here we can see that for this company, the actual earnings has beaten the analyst estimates for every quarter in the year 2020. Also, from the pull down menu, we can see what the analyst buy and sell recommendations were for each month this year. This shows that for the month of April, there were 14 analysts who were giving a strong buy signal, while one analyst was giving a strong sell signal for this stock. Finally, let us do a peer comparison of the stock price of this company using a normalized stock price chart. This shows that the share value of this company has grown by nearly 20% over a period of 6 months. So this concludes this tutorial on fundamental analysis of stocks, and I hope it was useful to you.